Imagine tax season approaching, and you feel that familiar knot of stress, especially when you think about finding all your business documents. Or maybe you have received a letter from the Internal Revenue Service, and suddenly you are scrambling to prove every single transaction. For tax purposes, small businesses need to retain all financial records that support their income, expenses, credits, and asset purchases. Generally, the Internal Revenue Service advises keeping records for at least 3 years from the date you filed your original return or 2 years from the date you paid the tax, whichever is later. However, some specific records requiring much longer retention periods. The core reason for meticulous record keeping is to substantiate every figure on your tax return. When you report income, you need proof of those earnings. When you claim a deduction for a business expense, you need documentation to show that the expense was legitimate, ordinary, and necessary for your business. The burden of proof always falls on the taxpayer. This means you must be able to demonstrate clearly and accurately how you arrived at the numbers you reported, whether it is for sales revenue, employee wages, or the cost of a new piece of equipment. For income, keep records like sales receipts, invoices issued, and bank statements showing deposits. For expenses, hold onto bills, canceled checks, credit card statements, payroll records, and mileage logs if you use a vehicle for business. Records related to asset purchases, such as equipment or real estate, need to be kept for the entire life of the asset plus 3 years after you sell or dispose of it. Additionally, employment tax records, like Forms W-2 and W-3, should be kept for years from the date the tax is due or paid, whichever is later. To make this process manageable, consider organizing your records systematically. You might use digital storage for scanned documents and cloud backups, or maintain well-organized physical files. Separating your business finances from personal ones from day one simplifies everything, which means having dedicated business bank accounts and credit cards. When in doubt about a specific record, it is always safer to keep it rather than discard it. Diligent record keeping is more than just a tax chore. It is a foundational business practice that provides peace of mind, ensures compliance with tax laws, and supports the overall financial health of your company. By maintaining clear, comprehensive records, you are not only prepared for any potential inquiry from the tax authorities, but you also gain valuable insights into your business's performance, helping you make smarter decisions and plan for future growth.